So we know that we are going to have the emergency budget or fiscal event, as it is known by some, on the 23rd. That's this Friday, the 23rd of September. And now begins that lovely period where we start to try to predict what might be in the fiscal statement, the emergency budget. Well, we've had plenty of clues, and we do know that this is going to be a slimmed down budget, a slimmed down fiscal event with a more full fat, so to speak, budget coming later in the year, probably sometime in November. So based on what we've understood during Liz Truss's leadership campaign during that time, and given what we've read in the press and what we know from all of that information that we've had, what could we, I say confidently, because I think we probably could confidently predict could be in the budget, and what also might be in the budget, and then what might not be in the budget. When I say budget, I am referring to the emergency budget, the slimmed down fiscal event. So centre stage will obviously be confirmation of the support that the government is giving in relation to the energy crisis. The government's planned intervention into the wholesale energy market will effectively introduce a £2,500 energy price cap for households, and that's going to be for 2 years, while retaining the measures announced in May. However, there's going to be an equivalent guarantee given to businesses, charities, and public sector organisations, but that's only going to last 6 months. So everyone wants to know a little bit more detail about what that amounts to. There could be, there's a strong chance, there could be a reduction in business rates for smaller businesses. Something else there could be, and this has been talked about a bit recently, is a temporary reduction in the rate of VAT applied to the hospitality sector. Now, that could be quite costly, so we'll have to wait and see, but that is something that has also been discussed in the context of more targeted assistance and aid. There could also be businesses and individuals are expecting, actually I said could also be, this is a nailed on one, I think, businesses and individuals are expecting the reversal of that national insurance increase made in April this year. That's been talked about quite a lot, and it will be an utter surprise if that wasn't put into practice. Now, of course, when that will happen and when it will flow through to pay packets remains to be seen. It's unlikely that's going to be an overnight thing. So we'll have to wait again and see what the detail of that is. There'll also be, and this has been talked about a lot, I think confirmation, formal confirmation, that is, that the corporation tax rise that was going up to 25%, remember, for businesses with profits of £250,000 or more. And then we had that marginal rate of 26.5% for profits falling between 50,000 and 250,000, and the retention of the 19% rate for profits under 50,000. So if all of that change goes and we're left with that unitary rate of 19%, that will be good news for those higher earning companies, but will mean nothing. I was going to say very little, but it will mean nothing to businesses with profits of less than £50,000. Another proposal that Liz Truss has made in the past is to go further in relation to what individuals can do, couples can do in relation to transferring any unused personal allowance. Right now, they can transfer 1 to 60 of their allowance, 10% effectively, to the spouse if it can't be used themselves, the spouse or civil partner, provided the spouse or partner pays no more than basic rate. It's been proposed, at least in the run-up to the election of Truss as leader of the Conservative Party and thus our Prime Minister, that the full allowance should be transferable. Now, no time was given for that, but that could be something that is also brought forward and referred to in the fiscal event. It's going to be quite costly if it is so, bearing in mind that the current 10% of personal allowance transfer costs around £600 million a year. Now, you'll remember at the same time that the national insurance increase was introduced, well, hopefully you'll remember, there was also an increase to the taxation of dividends by a similar 1.25%. Nothing's been said about that, and it will be very surprising if that were reversed in the same way that's proposed for the national insurance change. Then what else do we have? We have that promise effectively made by the last Chancellor that we will have a reduction in the basic rate of tax by 1% from April 2024. Could that be brought forward? It could be, but again, still quite costly, £6 billion a year to introduce that and bring that forward. So no mention has been made of that possibility by the current Prime Minister. So that's very much an outside bet, we think. Also, no change to the current system of pensions tax relief, despite the fact that every time a budget comes around, given the cost of that pension tax relief, there's always some discussion around, won't there be some change to that? No mention has been made of that, and we would be very surprised if there was any mention of that and any change proposed, definite change proposed in this fiscal event. Who knows what might come through in the full fat budget later in the year. And the same is true absolutely for the capital taxation. You'll recall that the Office of Tax Simplification proposals on both capital gains tax and inheritance tax, it was confirmed that neither of those would be proceeded with by the last Chancellor, Rishi Sunak. It will be an incredible surprise if Liz Truss and Kwasi Kwarteng brought that in now in relation to this fiscal event, the slimmed down emergency budget. Something could be said on capital taxation, of course, with the full fat budget, but we'd have to wait and see. Now, underneath all of this is, of course, a general concern expressed quite regularly in the press around cost and how that's going to be met. Liz Truss has said very clearly there will be a squeeze on Whitehall waste. There will certainly not be an increase in taxation. So where else could that money come from, given that we're almost certainly not going to have any kind of austerity measures? Much of the justification for tax cuts and the material increase in spending, which seems to be in opposition effectively, appears to rest on the theory that lower taxes will generate greater growth, and from that greater growth will come more taxes, the kind of compensatory tax yield. Whether that works or not, in the past, it hasn't worked terribly well. If you think back to 1972 and Anthony Barber, didn't work terribly well. Even Donald Trump's corporate tax cuts didn't work terribly well to achieve that growth spurt that we would be looking for. We also have to keep very much in mind in this context that the total national debt is currently 95.5% of the UK's GDP. Servicing costs on that debt will, of course, rise as interest rates are increased by the Bank of England and gilt yields also increase. So 2023 debt increase apparently could reach £100 billion. That's over 4% of GDP. As a parallel, few businesses would seek to borrow to invest during difficult economic times, with many choosing to preserve cash, which is just what this current government is not proposing to do. More detail will be forthcoming, we all hope, in this Friday's fiscal statement. We will be covering it in depth, as you would expect, in Techlink.